Right. So I have sent some PDFs on the platform. Do make sure that you go through the PDF. It will make what we are doing here very easy for you. Okay. If you understand the information in the PDF, you are going to understand most of the things that we will share with you. Okay. So make sure that you go through the PDF. All right. So today we want to talk about the very basic information about trading. Yesterday we did the intro. Today, we are going to look at some key terms that you are very likely to hear about them almost every day if you are really going to trade. Okay, so today we are going to talk about pips. We'll talk about pips, and then we will talk about lot size. Then we will talk about leverage, and then we will end with market structure. I will introduce you to market structure. Okay. Market structure is very broad. We cannot finish it even in 1 week. This will just be an introduction to what market structure is. Okay. But then the first three, I hope that we are able to finish everything within the day. That's not much, so we can do that. All right. So this is a common thing that you'll be hearing about. Pips, pips, pips. Those of you on the call who are already trading, I'm sure you know what a pip is. Okay. So a pip it's a unit change in currency value. Okay, a unit change in currency value. A unit change in currency value. So when we say a pip, this is the formal definition. Okay, but then what do we mean by this? So basically, what we are trying to say is that when a currency either increases or decreases by 1 unit, we call it what? A pip. If the currency value either appreciates or depreciates by 1 unit, we call it a pip. Okay. By standard notation, we say that a pip or one pip is equal to 0.001. Okay. One pip is equal to 0.001. Let me copy this. If that will work. But I want us to look at Euro USD so that the explanation will be very easy for us. Okay, great. Right, so a pip is equal to 0.0001. Okay, so basically, every currency pair is supposed to have 4 decimal places. It's not all of them, but most of them, they have 4 decimal places. I think with the exception of the Japanese yen. Okay. The rest are up to 4 decimal places. So look at something here. We have that the current value for Euro USD is what? 1.17638. Now, this 8 is just a micro value, which we don't normally consider. We consider only up to the 4th decimal place. Okay. So what this means is that as at the time that the market closed yesterday, Euro USD was trading at 1.1763. So I want to write that here. So EUR USD is equal to 1.1763. What this basically means is that if you have 1 euro, it is equivalent to 1.1763 US dollars. That is what it means. Basically, this translates to euro being stronger or bigger than what? USD. You get it. Right. So it means that if you earn in euros, when you convert your money to dollars, it should be more. All right. So what this pip means is that should this price increase from where it is now, to 1.1764, right? Then we say that Euro USD has appreciated by 1 pip because this has gone up, right? So we would say that Euro USD has appreciated by 1 pip. I hope we understand that. We will say that Euro USD has appreciated by what? 1 pip. So basically, if the value changes from where it is now, 1.1763 to something like 1.1793, then it means that if you want to note the difference, what are we going to do? I want us to do it together. So I'm going to use a calculator. Right, so we say it's what 1.1793 minus 1.1763. That gives us a 0.030. It's supposed to be 30, but because the zero is insignificant, that's why it's cuts it to 3. So it means that the difference is equal to this has appreciated by 0.0030. And in trading terms, we say the market has appreciated by what? 30 pips. This may be boring, but this is what is going to translate into either a loss or profit. Okay, so it's best you understand it. Let me put it this way. We nowadays our trading platforms have upgraded, and for that matter, the system does all this calculation for you. You don't have to do all this math. Okay, don't worry about it. But it is important you know where it is coming from, so that if somebody tells you they've been able to make say $1,000, you can look at their pips and tell them that you are lying, or you can look at the pips and tell them that that is true. You get it? So it's important we understand some of these things. All right. So how does this translate into money? How does this translate into money? That takes us to the topic lot size. Okay, lot size. So the lot size is the total quantity of the transaction that a trader takes at a time. The total quantity of the transaction that the trader takes at a time. Okay, and by the lot size, we have the standard lot size, standard lot size. And then we have the mini lot size, and then the micro lot size. Okay. So we have three of them. And then the standard lot size, it means that we are transacting 100,000 units worth of that particular currency, 100,000 units. Okay, you will get it with time. And then for the mini lots, that is 10,000 units, right? And then the micro lots is 1,000 units. Okay. So when you are using the standard lot, it means that you are completing 100,000 units of what? The transaction at a time. And this translates to $10 per pip. And then this also translates to $1 per pip. And then the last one translates to $0.1 per pip. So this means that if someone is using the standard lot size, then per every pip, the person is making what? $10. If someone is using the mini lot size, it means per every pip, the person is making what? $1. And if someone is using the micro lot size, it means that per every pip, the person is making what? 0.1 what do you call it? Dollar. And this is so the standard lot size, we mean that the person is trading with 1.0 lot size. Okay, the person is trading with 1.0 lot size. And with the mini lot size, we are saying that the person is trading with 0.1 lot size, whilst the micro, the person is trading with 0.01 lot size. Okay, so if someone is trading with 1.0 lots and the asset, let's say they bought Euro USD, and then the market appreciates from 1.1763 to what? 1.1793, which we have established that that is what an appreciation of 30 pips. What it means is that the person has made what? You multiply the 30 pip difference by the pip value, which is what? $10. And so that is what? 30 times 10, and that's equal to what? $300. So it means that if the market should move from 1.1763 to 1.1793, okay, and then the person bought it, they went in for a buy, and the person also used the standard lot of what? 1.0, the person has made $300 profit. If another person uses the mini lot size, which is 0.1, it means the person has made 30 times 1, and that is what? $30. Like I said, don't worry about this calculation. The system will do it for you. You just need to understand how it is done. Okay. And then if the person used, what do you call it? They used the micro lot, you are going to multiply, what do you call it, 30 pips by 0.03, and that is equal to what? $3. It means the person is going to go home with what? $3. So from the same pip value, someone is going home with $300, another person is going home with what? $30, and then we have someone who is also going home with what? $3. So basically, in trading, how much you make is dependent on your lot size. And the lot size that you can use as a trader is dependent on your capital. Okay, because if you want to use a very big lot size, then you would want to have a very big account. Because if your account size is small, you cannot take some of the big lot sizes. I hope that is clear. All right. So the lot size that you use is going to determine how much money you make. But then that one is also dependent on your capital. Because if you have, say, $10 in your account, you cannot use the standard lot size. It will not work. Okay. That is bigger than your account. Okay. I hope that up to this point, this is very clear. I'm taking my time to break it down further so that we will all understand it. All right. Now let's talk about leverage. Okay. Let's talk about leverage. And I want to open um, a new working space for that. Okay. So leverage. Yesterday I mentioned leverage, but today we want to look at it into detail. So leverage, I said that is it amplifies your buying power, or it gives you more buying power. So this is the thing. Because the currency prices, the change is very small. Look at it. We are saying that the pip value is equal to this, which means if you are to enter the market and the market moved by a pip, it is just equal to this. And if you know maths, you know this is what? Very insignificant. So in order for you to make money, it means this has to move by 1 million times before you make something like $10, okay, which is going to take you forever to achieve something like that. So what the brokers do is that they offer you a leverage, which is more or less like a loan. What it does is it amplifies your capital so that you can take bigger positions, or you can take more position, so that even with the least change in pip value, you can also make something significant. So let's see how that works. Let's say that broker A, right? So we say broker A offers a leverage of 1 is to 20, right? Or let's say 1 is to 50. And then broker B offers a leverage of 1 is to 100. Sorry, 100. Now, how does this mean, and how does it, oh, sorry, what does this mean and how does it affect you as a trader? Let's look at it. So we are going to use this same pip value change, okay? So what this means is that if you are to deposit $100 in your account, right? If you are to deposit $100 in your account with broker A, you are basically trading with broker A. You are basically trading with, you multiply 50 by 100, and that is what? $5,000, right? That means you are trading with $5,000. Sorry, broker A. And then for broker B, what it means is that you are basically trading with, you multiply 100 by 100, and that gives you what? $10,000, right? So if all of us are using standard lot size, so let's say there are two traders, okay? One is trading with broker A, and the other is trading with broker B. They have all deposited $100, all of them have deposited $100, and they went in for a buy on Euro USD. They bought Euro USD, which appreciated from 1.1763 to 1.1793, which we have established that is what? 30 pips value. How much are they going to make? Depending on the brokers that they are trading with. Remember, we are saying that they are all trading with what? The standard lots. They are all trading with the standard lot, which means that a pip movement is what? Equal to $10, right? So how does this translate? How much profit are they going to make on this? So basically, you are going to multiply their capital by 30. You are going to multiply their capital by 30, and that is the profit that they are going to earn on their trade. That is the profit that they are going to earn on their trade. Bearing in mind that they are trading with what? The standard lot. So you are going to multiply broker A. For a trader who is trading with broker A, you are going to multiply 5,000 by 30. And that is how much profit the person is going to make. I think that is 1,005, sorry. Is it 15,000? That is how much profit they are. Sorry, no. Let us do that here. The calculator, where is it? Good. So we have trader A, who is trading with broker A, and then they gave him a leverage of 1:50, and that has amplified his capital to what? 5,000. So we are going to multiply that by what was the pip value? 0.003, and that is equal to what? $15, right? So it means that broker A, sorry, where is it? Right, I want this. So the trader A is going to make how much? $15 based on the leverage that is given. Based on the leverage that is given by the broker. Now, what about trader B? So trader B, how much is trader B also going to make? So you multiply, where is it? So we have the calculator here. So we have 10,000 by 0.003, and that's equal to $30, right? So we have that trader B is also going to make what? $30 profit. So it means that the higher the leverage, the higher the returns. Okay, when you are trading with the same capital, but then trading on different leverages, then the one with a higher leverage is going to earn more. Remember, I want you to remember something. You see that you deposited $100 in your account, right? You didn't deposit $10,000. So it is 30, this $30 will be added to your $100 and not the $10,000. So it means that trader B has made a profit of $30, and the $30 will be added to the deposit that they made, which is what? $100. And so it means that after the transaction, trader B has $130 in their account. You understand that? Same way, trader A, who trades with broker A, is going to have $115 in their account. That is how it is done. Now, this is where it gets dicey. So in this case, the market went in their favor, and that is why trader B is smiling, right? Assuming they went for a sell and the market rather appreciated by 30 pips, what it means is that trader A is going to lose only $15. So at the end of the day, trader A is going to be left with what? $85 in his account, right? And then trader B is going to be left with what? $70 in his account. So they took the same trade, the same lot size, the same capital, but because of the leverage, trader B has lost $30 and then trader A lost only $15. So I hope you get how the leverage works. So it means that the higher the leverage, the higher the returns, also the higher the losses. So you should know how to use the leverage well. So as beginners, when we are starting, it's best that we trade with brokers that offer very small leverage so that we don't blow our accounts easily. I believe that this is simple. Again, I will mention it. Don't worry about these calculations. Everything has been done in the system. So when you put your money there, you don't even see the leverage playing out. But then every profit that you are making, it is as a result of the leverage. That's why you are able to make the profit. Also, every loss that you incur is as a result of the leverage that you are making that losses. Okay. So these are some technical things that you need to understand. Okay. So that when you start trading, the certain things will be very easy for you. Okay. Now, the next thing that we are going to talk about is market structure, right? We are going to talk about market structure. Okay, so we have trending markets, then we have ranging markets, and then the third one is choppy markets. All right. So before you trade any market, you would either want to buy or sell. And that decision is based on the structure of the market, what the market is doing at that instant, whether the market is going up or going down. That is what we call the structure. Okay. So what the market is doing at a particular time, that is what we refer to as what the structure. Now we have scenarios where the market is trending. Now, when the market is trending, we have two sides. It's either the market is trending up or it is trending down, right? So we have what we call uptrend and then downtrend. So in trending markets, we can only have uptrend or downtrend. And then in ranging markets, you see that the market is trading within a bound, like it is trading in a zone, a strap within a zone. As in, it has the highest peak and then a lowest point. All right, so we are talking about something like this. The market be doing something like this, it's trying to converge around the same high and then converge around the same low. When it is doing something like this, we say it is what? Ranging. I'll show you more about the trending as well. Right. And then we have the third one is choppy. Now for the choppy markets, it is when the market haven't taken any form. So it is not trending upwards. It is not trending downwards. It is not ranging. So you can't really tell what is happening in the market. It is scattered. That is what we call a choppy market. And as a trader, you would want to avoid this market at all costs. You don't want to trade this market at all. This one. Yeah, you don't want to trade it at all. So avoid this market, the choppy market, avoid it. Okay. So we are either going to trade in an uptrend or a downtrend. And sometimes we will trade the ranging market. So let's look at the uptrend. When do we say a market is an uptrend? When a market is in an uptrend, it does something like this. You see the market leaving lower regions into higher regions. Okay. When the market is an uptrend, it leaves lower regions into higher regions. All right. So what we basically means is that the price of the market keeps on appreciating. That is what happens in an uptrend. And then for a downtrend, we have that the market is leaving higher prices for lower prices. So it is dropping in value. Okay, that's something like this. So if you notice that the market is doing something like this, then you say it is a downtrend. All right. And like I illustrated, I said that with the ranging markets, the market tends to align around the same high and then the same low. When you see something like that, we say it is what? Ranging. So this is just a mere or a layman way of identifying the structure. So we are going to use that approach to tell the nature of some markets. Okay. Now, God willing, tomorrow we will start with technical analysis. Now, the technical analysis, we are going to learn the technical meaning of what? An uptrend. We are going to learn the technical meaning of a downtrend and then the technical meaning of a ranging market. I hope you get it. So, like I said, the lesson is progressive. If you miss any of the lessons, you will not get the next lesson. So it's best you show up for all the classes. Okay. So now let us try to identify some market structure. So we are just going to look at the market and see what it's doing, and then we'll try to tell the structure. So if we look at this market, if nothing at all, we can see that the market is going up, right? It's going up just like something like this. It's doing something like this. So this, we can tell that the market is about in an uptrend. This is clearly an uptrend. The market is going up. This is an uptrend. Okay. Right. Over here too, we have that the market is in an uptrend. You can see clearly from here, right? The market is leaving lower prices, right? For higher prices. You can see them. This is a layman way of doing it. We have a proper way of doing it. That is what we will do, God willing, tomorrow. All right. Okay. But then when we observe the market from this side, okay, let's observe it from this side. What do we see? We see that the market was rather leaving higher prices and then it was targeting lower prices. Look at it. You see, it is going down, right? Yes, that is what it's doing. Good. So this is what we call a downtrend. So we say this is what a downtrend in market. All right. This is a downtrend in market. Okay. So the ranging markets don't normally form the choppy markets as well. So um, let me see if you okay. And then the market doesn't range for a long time. It also doesn't consolidate for a long time. So if we look at this part of the chart, we can see the market was doing something. You see that it has some equal lows down here, 1 and 2, and then it has some equal highs down here. So in this particular scenario, the market was ranging within this space. So when it got up here, it came down. When it got up here, it came down. Same way down here, it went up, right? It went up. So that is it. When you see that the market is doing something like that, we say it is ranging. And for the consolidation, um, you are just not likely to tell the trend of the market. If you look at something like this, these are not equal highs. These are not equal highs, right? So within this region, the market was consolidating. Within this region, the market was consolidating. It didn't give us a clear direction. Okay, right. So, as beginners, we are going to focus on the ranging markets, right? We are going to focus on the trending markets. That is the ones that are trending upwards and then the ones that are trending downwards. So let me add something to this and then we can go. Oh, where is the market structure? It's gone. Did I delete it or something? All right, so I just want to add that when the market is in an uptrend, okay, when the market is in an uptrend, we buy, okay, and then when it is in a downtrend, we sell. All right. Now, by the end of the entire mentorship, you will understand why we buy when the market is in an uptrend. And then also, you understand why we sell when it is in a downtrend. We also learn that when the market is ranging, we are going to buy it at some point and we are going to sell it at some point. That one too, you will get to understand it within the course of the lesson. But for a choppy market or a consolidating market, we are not going to trade that market at all. We are not going to trade that market at all. All right. I hope that that is clear. All right. So that is what I have to share with you this evening. God willing, tomorrow we will start looking at what technical analysis, and we are going to understand the technicals behind uptrend, downtrend, and then ranging markets. I hope this is clear. If you have any question, kindly go ahead, either put it in the chat box or mute your microphone and speak up so I address it. Thank you very much.